Welcome back to the Deep Dive. Today we're diving into material from one of the really respected names in currency trading, Kathy Lien.
That's right.
Our goal here is to build you a systematic, sort of comprehensive framework, not just for understanding Forex, but for actually trading it.
Right, based on her insights.
Exactly. This isn't just theory, is it? It's about turning global economics into, well, practical strategy.
Absolutely. And our main source today is the Little Book of Currency Trading. It's important to know where this comes from. Lien, she's the Director General of FX Strategy at BK Asset Management, writes for Bloomberg Markets. I mean, she knows her stuff.
Clearly.
And this book, it's really known for making complex Forex ideas, things that can seem intimidating, much more accessible. Doesn't matter if you're just starting out or if you're seasoned.
Yeah, making it actionable. That's key.
Exactly.
Okay, so the book seems to have this dual purpose. Get the fundamentals down, the forces moving currencies, and then build a solid framework for actually operating. So if we want to get this right, we can't really skip steps. Let's start at the bottom. What are the core drivers Lien says we absolutely have to understand?
Okay, so Lien lays out these 4 essential pillars. And she really emphasizes, you can't just focus on 1 or 2.
Right.
Success means understanding how all 4 interact. They're often working at the same time, pushing and pulling the market.
Got it. So pillar number 1?
Pillar 1 is the most traditional, economic fundamentals.
Yep.
The idea here, it's simple but really crucial. Countries sort of have economic personalities.
Interesting way to put it.
Yeah, and the currency, it's like the immediate reflection of that personality. So we're looking at the big levers here.
Like interest rates.
Exactly. Interest rates, central bank policies, the ECB versus the Fed, that kind of dynamic.
And it's not just what the central banks do, is it? It's also the general health check stuff.
Precisely. You've got the national health measures like GDP growth, employment rates, but also the external health things like the trade balance and, crucially, inflation. Inflation's huge because that's what central banks fight with those interest rate tools.
The amazing thing about Forex is how it's all about relativity.
Yep.
This pillar shows that straight away, doesn't it? Like if you look at USD, it's not just, is the U.S. doing well?
Right.
It's, is the U.S. doing better or worse than the Eurozone? It's like this global comparison contest, constantly.
That's a perfect way to think about it. A global booty contest where the currency with the relatively better story attracts the money.
Yeah.
And that leads us actually right into the second pillar, capital flows.
Okay. Where the money's actually moving.
Exactly. This is really the engine. Money chases opportunity around the globe. Simple as that. If rates are higher somewhere or growth looks better,
Capital flows out.
capital flows in, demand for that currency goes up, and its value strengthens. It's fundamental.
But Lien makes a distinction here, right? Not all capital flow is the same. It matters for stability.
Absolutely critical distinction. You have to separate foreign direct investment or FDI.
The long-term stuff, building factories, buying companies.
Exactly. That's sticky money. It's committed.
Yeah.
Then you have portfolio flows.
The faster money.
Much faster. Investments in bonds, stocks. It's way more liquid, more speculative.
So it could flood in.
Flood in quickly, yes, but it can also vanish even faster if sentiment changes. Whiplash.
And if we connect that idea, especially thinking about, say, emerging markets, those flows take on even more importance, don't they?
Hugely important. In developed markets like the U.S. or Europe, economic fundamentals often carry more weight day to day. But in emerging economies, those portfolio flows can be incredibly powerful. Sometimes they just overwhelm the local economic data, for a while at least.
So a shift in global mood can just hammer an emerging market currency.
Like a wrecking ball. If sentiment sours, you see capital flight, and it's devastating.
Okay, that makes sense. So fundamentals, capital flows. What's pillar number 3?
The third one, and maybe the trickiest to quantify, is market sentiment.
Yeah, the psychology.
Collective psychology, exactly. Is the market feeling brave, looking for yield risk on? Or is it scared, running to safe havens like the US dollar or the yen risk off?
But how do you measure something like fear or greed across the entire market? Seems fuzzy.
It is fuzzy, but Lien suggests using specific tools as proxies. She mentions the VIX index, the volatility index.
The fear gauge.
That's the one. And also watching correlations between assets that usually move together.
How does that help?
Well, when things are calm, assets trade in predictable ways. But when panic hits, correlations break down, everything goes haywire, and everyone rushes for the same exit. Fundamentals might not matter in that moment.
Right, sentiment just takes over, like a temporary override based on feeling, not facts.
Precisely. Which leads us neatly into the fourth pillar, which is all about tracking the evidence left behind by all this action. Technical analysis.
Okay, the chart.
The charts. This works on that powerful idea that the current price reflects or discounts all known information.
So the technicians are reading the footprints of the buyers and sellers.
In essence, yes. They're less worried about why a country's economy is strong and more focused on where traders have historically shown conviction, where they bought or sold before.
And what are the main tools Lens points to here?
She highlights dynamic support and resistance levels, those price zones that seem to act like magnets or barriers. And also reading candlestick patterns, especially understanding how they form across the different global trading sessions.
And this seems crucial from the book. Technicals don't live in a vacuum, right?
Absolutely not. This is key to Land's philosophy. Technical analysis gives you the timing, the entry, the exit points.
Good.
But the fundamental analysis, pillars 1, 2, and 3, that has to give you the conviction for the trade's direction, why you're taking the trade in the first place.
Okay, so fundamentals say the euro should go up against the dollar. Technicals tell you precisely what level looks like a good entry point based on past behavior.
Exactly. They work hand in hand. You need both.
Right, we've got the four big forces. Now let's shift from theory. This is where it gets really interesting for day-to-day action. How do we apply this understanding to the structure of the trading day itself, the different time zones?
Yeah, this is super practical. The market has these 3 main global sessions, and trading feels very different in each one. A smart trader adapts.
Okay, walk us through them.
First up, you've got the Asia session. Think Tokyo, Sydney.
Right. Generally quieter?
Generally, yes. Lower volatility, often thinner liquidity, especially if you're not trading Asian currency pairs.
So what kind of trading suits that environment?
It's often good for range trading, betting that prices will bounce between known support and resistance levels because there isn't usually a strong catalyst to break out. It's like the market finding its footing.
Then things pick up significantly when Europe comes online.
Dramatically. The London session hits, and that's where you see the highest liquidity globally.
Why is that?
Well, Europe's fully active, the big banks are making their moves, and it starts to overlap with North America. All that capital converges.
And what does that liquidity mean for trading?
It often means clearer, more sustained trends can form. If you're looking for a trend to ride, the London session is often the best place to spot it taking shape.
Okay, London sets the trend, and then comes the U.S. overlap.
The New York session, this is vital. It overlaps with London for about 4 hours, a period of intense activity.
And this is prime time for
reactions to major U.S. economic data releases. If a big report drops, like jobs numbers, inflation, the reaction during this high liquidity overlap is usually fast and furious.
Speaking of furious reactions, Lien talks about trading the news as a favorite method. High potential, but sounds risky.
It absolutely is. It requires serious preparation. Think about the big one. The U.S. non-farm payrolls, NFP, report each month.
Yeah, that always moves markets.
You don't just wait for the number and react. Lien stresses preparing scenarios. What if it's much better than expected? Worse, right on target. You need a plan for each.
So it's about anticipating, not just reacting.
Exactly. But, and this is a huge, but the source is incredibly clear about the danger.
The volatility.
Insane volatility also. And you get whipsaws, the price flies up, then down, then maybe finds a direction.
Sounds like a recipe for getting stopped out instantly.
It is. If your risk management isn't rock solid, it becomes absolutely non-negotiable during news events. The speed can just crush you otherwise.
Which brings us perfectly, I think, to the most critical part. Risk management. Lien calls it the rule of gold.
It really is the foundation of survival. Forget fancy strategies if you can't manage risk. Long-term success in Forex, it hinges entirely on discipline here.
And she gives a very specific rule, doesn't she?
A hard quantitative rule. Never risk more than 2% of your total trading capital on any single trade.
2%. That sounds small, but I guess it forces you to stay humble.
It ensures no single loss, no matter how bad it feels, can cripple your account. It keeps you in the game.
How do you actually enforce that, though? In the heat of the moment, sticking to 2% must be tough.
You enforce it with tools, specifically smart use of stops. Lien advocates for dynamic stops, not just setting a level and forgetting it.
What's the difference?
A static stop stays put. A dynamic or trailing stop moves with your trade. If the trade goes in your favor, the stop moves up to lock in profit or reduce the initial risk.
Ah, so your maximum potential loss keeps shrinking as the trade works out.
Exactly. You're actively managing risk exposure as the market moves.
And beyond the tools, there's the mental game.
Oh, absolutely. Lien makes it clear, discipline is an internal battle. You need resilience to take losses without freaking out and trying to win it back immediately.
The revenge trade.
The deadly revenge trade. But just as important is handling gains. Don't get overconfident after a winning streak.
Right, thinking you're invincible and bumping that risk up to 5% or 10%?
That's often the fastest way to blow up an account. Overconfidence kills.
Okay, so looking back over this whole systematic approach, the pillars, the sessions, the risk,
Right.
what's the single biggest takeaway for you? The core lesson?
For me, it echoes what you said earlier. It's that constant focus on relativity.
Yeah.
Forex is always a comparison. It's never just buying or selling one thing in isolation. It's always currency A versus currency B. Which economy looks stronger? Where is capital flowing between them? Understanding that contrast is everything.
That really is the heart of it. It changes how you see the charts in the news.
It does. And maybe adding one layer of nuance to that. Remember how the pillars are weighted differently, especially for emerging markets. If you're trading, say, USDMXN, the dollar versus the Mexican peso, or USDBRL against the Brazilian real.
Right.
Tracking those global capital flows and overall market sentiment often becomes more critical than drilling down into every single local economic report. The global tide matters more.
That's a really practical insight. So who is this book, this framework, really for?
I'd say it's not necessarily for absolute beginners who don't know what a pip is. It's more for traders who get the basics, but want to build a truly robust, systematic way to connect the dots from economic news to actual trading decisions. If you want to move from guessing to analyzing methodically, this is gold.
Sounds invaluable.
Yeah.
And our final recommendation, echoing Lien's own sensible advice, has to be
Practice. Combine reading this, understanding it, with tons of practice on a demo account.
right. Test the framework, build the discipline.
Feel the pressure, see how you react before you put real money on the line. It's essential.
Couldn't agree more.
And that brings us to the final necessary warning, straight from the source, always worth repeating. Forex trading involves high risk. Past performance doesn't guarantee future results. Only trade with capital you can genuinely afford to lose.
Crucial advice.
Now, for that provocative thought to leave you with, Lien hammers home that 2% risk rule as non-negotiable for survival. So the question is, given how simple that rule sounds, what specific psychological traps, maybe fear of missing out, maybe the urge to recover a loss quickly, make sticking to that simple 2% so incredibly difficult, even for experienced traders when the market's going crazy?
Something important to reflect on as you build your own discipline. Excellent point.